Good afternoon, or good morning. I'm Steve Jewell, and I'm with Community Giving, and we'd like to welcome you to our Professional Advisor webinar this morning. As you can tell, I'm in the habit of saying good afternoon because normally we've been doing these webinars in the afternoon. And so old habits die hard. And we just want to welcome everybody to this webinar, giving people a few minutes to log on. We have been doing these weekly webinars since we've all been staying at home and trying to have it be so that we could stay connected with the people and the communities that we serve. And of course, the professional community is one of our key communities that we do serve. And we really wanted to be here to support all the nonprofits as well as our donors, because there's a lot of needs in our community today. And we really feel as a community foundation, our role is to be here and provide value during these challenging times. And so today, we're very fortunate to have with us Joe Thiegs. And he's going to share with us some information that we feel is important during this time, and some reminders of how professionals work during this time of crisis. And so we have been having a few technical difficulties, just not getting Joe's camera to work correctly on his end, but what is going to happen is he'll be able to hear him just fine, and we have his photo there, so it'll be just like he's with us. And if it gets to working during this process, then great. If not, hopefully you'll still get all of the great information that he's planning to share. We'd like you to keep your computer on mute. We will have time for questions and answers as we get to the end. And if you have questions, please just submit them in the tab below, and we'll be happy to answer the questions as time allows. And if we can't get to all the questions, we certainly will still follow up with answers after the event. Also, we have applied for continuing education credits that has qualified for 1.5 continuing legal education credits. We also believe it will qualify for some of the other areas as well, and you will be able to get a copy of all the slides and submit them for your continuing ed credits. We have done these professional advisor events, usually live, in the past, and so this is the first time we've done it completely remote. It is being recorded, so if you aren't able to stay for the whole presentation, know that you can get a copy of it afterwards and be able to listen to it in its entirety. So once again, thank you so much for joining us. Before we get started with Joe, we're going to introduce each of our executive directors and the communities they serve, and have them say a few words about what they're doing currently with regard to supporting their community during this crisis, as well as let you know that they're there to serve as a resource. And we're going to get started with Holly Witt, who's the executive director of the Alexandria Area Community Foundation. Holly.
Thank you, Steve. Well, as Steve said, my name is Holly Witt, and I am the Executive Director of the Alexandria Area Community Foundation. I started in October of 2019, so I am about 7 months in, almost exactly. I would like to, before I go on any further, just welcome everyone to the call, professional advisors, and I know we have a number of nonprofits who are on the call too, and just to thank you for all the work you're doing. I know, especially from the nonprofit side, just the tough decisions you're having to make right now, and the difficulty of everything you're going through. So that's why we're here for you, and we want to provide resources and dollars through our response funds. And so we're glad that you're with us today, and thanks for all you do. So 4 months into my work at the foundation, we had a downtown fire. And so it was at that point, the end of February, that we actually created our response fund. And so we gave out about $38,000 to fire victims through that. And then we transitioned quickly into COVID response. So we have a grant committee that's meeting weekly. We have committed 9 grants so far for about $45,000. And so we still have funds left, and we're meeting weekly and taking applications and focusing right now on basic needs and emergency needs, housing, childcare, mental health, those kinds of issues. And so welcome those applications, and any conversations or questions people have on that, feel free to give me a call. My contact information is there. and just to know that we're here to serve you. So we appreciate all you do. So with that, I'm going to turn it over to, I believe, Carl.
Thank you, Holly. And I want to echo my thanks to all of our viewers out there for the work you're doing at this time, and we welcome you to this session. So I would be the contact for any professional advisors in the greater Brainerd Lakes area that would want to follow up with helping any of their clients with what we're talking about today or any other charitable giving opportunities that they might have. We too have a response fund. We've raised about $133,000 for that. We've given out over $53,000 so far. So we have a balance of about 80,000, and that's when some committed funds come in that we know about. So we're also meeting weekly as a grant team and making decisions as those come out. So thank you again for being here, and I'm going to turn it over now to Carol in the greater St. Cloud area, central Minnesota.
Thanks, Carl. I just wanted to let you know that we are working hard in St. Cloud as well, just like all of our sister organizations. We have our response fund going. We currently have about $135,000 available in that fund. One of the things that we're looking at is how do we support nonprofits after COVID. We've been concentrating all of our efforts on relief currently because we want to help with those unmet needs, but we are thinking about the future, and a lot of nonprofits will be struggling to recover from the fact that they have not had a lot of their fundraising events. And so determining what we do to help them is one of our biggest concerns. In addition to that, we've been doing virtual bus tours with United Way, which allows us to share with donors what some of the nonprofits are doing to help battle this pandemic. And we've had a great response on that. Around 100 people have been attending. So that's it in a nutshell for St. Cloud, and I'll turn it over to Sarah.
Good morning, everyone. I'm Sarah Carlson with the Wilmer Area Community Foundation. Very glad to have all of our Wilmer and Sauk Center area advisors and allies on the call with us today. We're pleased that you're going to have a chance to hear from Joe about two really impactful opportunities for gifting that I can testify have been transformational in the Wilmer market, both charitable gift annuities where we have benefited and agencies have benefited in our area from an elderly gentleman who saw the wisdom in a market very similar to this and left a lasting legacy over $2 million in charitable gift annuities. And another tool that we've benefited from around a charitable lead unit trust that has given us about $30,000 a year to grant back into our communities. So I'm excited to have you all hearing about that. Like our sister foundations, we too are working very hard on leadership in the communities of both Wilmer Lakes area and the Sauk Center area, trying to unite and unify folks and think about how can we power our communities towards recovery. We are too in relief at this moment via both of our response funds. The Wilmer Response Fund has granted out about $80,000, and we have about another $140,000 available. I expect that we will work on some resilience and recovery work soon. And in Sauk Center, we have about $40,000 available and are focused exclusively on relief, but hope to pivot to recovery in short order as well. So I think at this point, we'll send it back to Carol, who will introduce our main speaker. Carol.
Thanks, Sarah. So Joe is a great speaker. So we have a good couple hours with him to be able to learn from him. He is the president and owner of the consulting firm General Works LLC. He specializes in plan giving consulting and training, values-based estate planning, and family philanthropic advising. Among his roles as a consultant, Joe is a vice president and representative of Thompson and Associates and is the national plan giving advisor for Greater Public. Until making consulting his full-time occupation in 2019, Joe was the plan giving director at Minnesota Public Radio and American Public Media in St. Paul, Minnesota. Prior to that, he worked as Associate Director of Advancement in the University of Minnesota Law School, as a plan giving officer at the University of Minnesota Foundation, and as an estate planning attorney at Dorsey and Whitney LLP in Minneapolis. Joe is a regular speaker, presenter, and trainer on topics related to plan giving, philanthropy, and estate planning, including several years as a presenter of Minnesota Plan Giving Council's A Brisk Walk Through the Basics. Joe currently is on the board of directors of MPGC and is a member of the National Association of Charitable Gift Planners. Previously, Joe served for several years on the governing council and the legislative committee of the Minnesota State Bar Association's Probate and Trust Law section, and was a member of the MSBA Joint Task Force evaluating and making recommendation for adoption of Minnesota's version of UPMIFA. He earned his BA in political science and sociology from Northwestern University in Evanston, Illinois, and his JD from the University of Minnesota Law School in Minneapolis, Minnesota. Please welcome Joe Theeks.
Hello, everybody. Can you hear me all right?
Yes.
Great. Thank you so much, Carol, and thank you, Steve, and Community Giving for inviting me to speak today. I'm sorry the camera is not working. I even, as I said to the other panelists and the directors earlier before we started and we were trying to troubleshoot, I even dressed in a suit today for the first time in quite a while for all of you. So I'll just imagine that I can see you and you can see me. I wish that we could be together in person. I love doing these presentations face to face, but of course that's precluded by current circumstances. So thank you so much for taking the time to be with us today. My hope for the day is that we will end up conveying some information that hopefully will be helpful to you in your practice as you're working with clients, with donors, and that you can come away with at least one thing that you find useful in your day-to-day practice. So if you have any questions at the end, I think we'd be best in this format to hold them for the end. Usually I like to be a little more interactive, but given that we can't see everybody if they're raising their hands, let's keep a running list of questions, and hopefully we should have some time at the end to talk about some of those. So again, thank you for having me here. I'm really grateful for the opportunity. And also, I'd encourage you to, just like if we were in an in-person meeting, it's a lengthy presentation. It's over an hour and a half. So if you need to, get up, stretch your legs, walk around, go get a cup of coffee or water or whatever beverage you're drinking. I won't judge. And just to make sure that you're comfortable throughout as well. But we'll keep going through, I think, without any breaks. And we'll look forward to the next couple hours together. So Christine, if you wouldn't mind advancing to the next slide, please. All right, just to give a general overview of what we plan to cover today, the first thing is client relationships in times of stress and crisis, and how can we be there for our clients. We'll talk a little bit about changing approaches to estate and financial planning over the years, different methodologies for doing estate and financial planning for you to consider. We'll talk about different plan giving vehicles and techniques, and the general context of plan giving, provide some basics for that. I know that'll be review for a lot of you. For some, it might be new, and maybe you'll pick up something along the way. And then we'll go over a review of different charitable gift opportunities by asset type, by type of property that your clients might have. And then finally, at the end, we'll do a little bit of Q&A. Before we go to the next slide, I just wanted to say that, or acknowledge that this is a really difficult, challenging time for a lot of us, and for many of us, it's been a chance to reflect a little bit about what's really important in life and prioritizing what is most important to us. If you'll go to the next slide, please, Christine. I just inserted this picture of our family. This is my wife, Lisa, and our three kids, Jacob, Ellie, and Samantha. Jacob's a senior in high school this year, and so looking forward to graduation, the celebrations, and prom, and all that kind of good stuff, spring sports, and that's, of course, all been canceled. But we've had a lot of time together, and even though and we still love each other like crazy, even though every once in a while we drive each other a little crazy. So I just wanted to put this picture on here. It's not the best picture of us, but it was one that was taken by one of our neighbors who went around and wanted to take photos of all the families on the block. This is Saturday before last, before it became winter again in Minnesota. I think I heard it was 18 degrees in International Falls this morning, a record low. And when you have a record low in International Falls, that's saying something. But I also heard in the forecast today that that warmer, brighter weather is around the corner. So let's hope that's a metaphor that holds true for the rest of our society and economy and clients and our practices as we go forward. But I hope that all of you and your families are doing relatively well in this difficult time of uncertainty, and just wanted to express best wishes to each of you for that before we begin. All right, next slide. So client relationships in times of stress and crisis. Next slide. As we all know, we're in the midst of this pandemic of coronavirus and COVID-19, and it's really affected almost all aspects of life for all of us, and not just us, but our clients. Our clients have physical health concerns, that maybe they are sick themselves, or they are an at-risk population if they're immunocompromised, or in an elderly age group, or have one of the other risk factors, or maybe it's not them that they're worried about, but a family member. So just noting that there are all these health concerns right now that we didn't have a couple of months ago. Financial concerns, as the economy is taking a real beating, and a lot of people's personal finances have too, with furloughs and layoffs and firings, other job losses. Things have largely ground to a halt as we've had to shelter in place and can't be out doing the things we normally do and spending the money we normally spend on various services. So finances are a real concern for most people right now. Emotions and mental health. I think it's important not to neglect or ignore the emotional aspect of this. A lot of times people might be in a perfectly fine place physically and financially, but they are still worried, that they feel concerned. Also, the isolation can have a significant toll on mental health. And by the way, May is Mental Health Awareness Month, so I encourage everybody, if you're having a rough time, to go talk to somebody and check in on your friends and neighbors to see how they're doing. It's really important in this environment, but that's something that we have to consider along with what we normally do as financial estate professional advisors, focusing on the financial side and the tax side, but also not to ignore this emotional side of planning and the process and what folks are going through. There are and then logistical challenges that I'm sure that many of you have experienced. If you have a client who wants to proceed with certain planning, how do we do that? if we have to stay 6 feet apart and they're concerned about contracting illness, or you're concerned about contracting it or transmitting it, what kind of processes do we have in place to allow us to do work, if we even can? To what extent is what we do essential service? And in some of the executive orders, as we've seen, that end of life planning is an exception to closure of businesses, and different people come down in different places. Some folks would argue, and I think this is right, that any kind of estate planning is really end of life planning, because you never know when end of life is going to be coming. But in doing so, we have to find ways of getting documents executed and reviewed, and in some case witnessed or notarized. Those can all be challenges as well. So there's logistic challenges too. Next slide. As a result of this pandemic, there have, of course, been government responses and legislation. And the first of those is executive orders on the federal level, maybe not as many on the federal level as on the state side, as the federal government has largely delegated that authority and responsibility to the governors and state administrators. And in Minnesota, of course, we know we've got our shelter-in-place order that had been imposed, and closure of businesses with a little bit of adjustment over time, extension of those orders, and we'll see what the next couple of weeks bring here in Minnesota. On the federal level, there has been significant legislation in the form of the CARES Act, Coronavirus Aid, Relief, and Economic Security Act, that I'm sure all of you have heard a lot about as advisors. But just as a quick review, there are economic injury disaster loan funding increases, Paycheck Protection Program loans for small businesses and nonprofits, cash payments to families and individuals. That's the $1,200 payment that is provided to individuals with additional $500 credits for certain children, I think dependents under age 17. And then, oh, by the way, I heard also on the radio this morning that I believe tomorrow at noon Eastern time, so 11 a.m. Central, is the deadline for individuals to have their taxes for 2018 and 2019 filed in order to receive those $1,200 payments if they haven't done it already. I'm guessing most people have submitted that, but in case you're talking with donors who are wondering about it or clients who are wondering about it, I believe tomorrow is the deadline for getting those filed. And then broadened unemployment payments and benefits and eligibility. That's a $600 weekly benefit at a federal level added on to the state benefits, and expansion of that program to people who would never qualified for it before, including independent contractors and freelancers. Tax return and payment and student loan deferrals that now for federal purposes and Minnesota, most taxes, rather than being due on April 15th, are now deferred to July 15th for filing and for payment of the 2019 taxes. Interestingly, of course, if you pay estimated quarterly taxes, you still had to do the 2020 first tax payment on April 20th, and then there's another quarterly payment, I believe, due on June 15th. So it's kind of funny that you end up paying your 2020 taxes before your 2019 taxes, but that's one of the quirks of the law. And then also elimination of required minimum distributions from IRAs, 401ks, and other qualified retirement accounts in 2020. Next slide, please. Additional provisions that are relevant to charitable giving are increased incentives for charitable gifts from individuals, particularly for cash gifts. So there's now, it looks like in 2020 only, there's been some debate about whether it applies for further years, but the guidance that I've seen indicates likely 2020 for $300 of cash gifts. That's an above the line deduction for non-itemizers. So even for those people who take the standard deduction and wouldn't ordinarily itemize, they can get a tax benefit by making cash gifts to qualified public charities this year. There also was some talk about whether for a married couple, for example, that might be doubled to $600, but the Joint Committee on Taxation report seems to indicate or suggest the legislative intent was that it would be $300 per tax-paying unit, which would include married filing jointly, so $300 for your clients. Elimination of the adjusted gross income limitation for charitable deductions of cash gifts to qualified public charities in 2020. Under prior law, there was a 60% limitation on the of your AGI that you could deduct cash gifts to qualified public charities of up to 60%. And I believe that cash gift limitation also applies to the 60% to donor advised funds, whereas the 100% cap or the reduction of that limitation does not apply to donor advised funds. So that it has to be cash or cash equivalent gifts to a qualified public charity, not to a donor advised fund or a private foundation. Which is just something to note there. Also, there's some increased incentives for corporate giving, including increase to 25% the deduction limitations for general charitable gifts and food donations, which previously had lower deduction caps of 10 and 15%. Okay, the next slide, please. So now to talk about the client relationship side. I think it's important, as we all know, communication is important in our practices. It's always important, but in this environment, it's especially important. One of the things that you may be feeling is a bit of a reluctance to ask your clients for business, and I would suggest that the first thing you do is not go to them to see if they want to update their plans. You don't want to seem crass or insensitive, given that a lot of people are concerned about their health right now. But really, the main thing is a check-in for each of your clients just a phone call and email to say, how are you doing? I was thinking about you the other day and just thought I'd check in, see if there's anything I could do to help. How are you feeling these days? Anything I can do. So that's, I think, really important, and people appreciate it. The other thing is that people are home, so they're available to take those calls and emails, whereas normally it might be hard to get a hold of some of your clients. Well, they're actually available now, and many of them are craving that interaction. So you might find that you get involved in some lengthier conversations, and depending on the size of your client base, you may not be able to have a long conversation with each of them, but even just a short message, well wishes, will go a long way toward making your clients know that you're there for you, that you're there for them, and to feel good about having had that contact or that outreach. On the nonprofit side, I know that a lot of development officers are taking this time when they're at home to go through their donor lists and just reach out and thank people for their past support. And I've been hearing anecdotally that a lot of folks are very appreciative and willing to talk, and that some other larger gift conversations have come out of that. So I think the same thing is true on the client side. Of course, the other thing is that there's the opportunity to provide legal and tax updates. With the changes in the law through the Secure Act and the CARES Act, there are a lot of nuances and changes that clients should be made aware of. So I know that many of you have been sending out broadcast updates. I think that's great. If you haven't done that, you probably want to do some client communication on some of these changes and how it might affect their situations. For particular clients where you know that they've got a certain situation or circumstance, you may, oh, hello? I'm hearing a little background noise. If you're not muted, if you wouldn't mind hitting mute for a second, please. Thank you. You can address the particular concern that you might have for them in an email or in a phone call, just to let them know about how the law changes might affect them. And we'll go over a couple of those a little bit later. And then, as I said before, just general offers of help, whatever you can do to be of service. There are some conditions right now that lend themselves well to particular planning techniques and opportunities. One is the very low Section 7520 rate, where you can do a little bit of arbitrage depending on what you have in the way of assets and how much you expect them to grow versus what the assumption is under the Section 7528 right now, rate right now. Depressed asset values, there's been a lot of volatility in the market, and the result of that is that some donors are holding assets that are worth a lot less right now than they were maybe just a year ago or several months ago, and you can take advantage of that for some planning techniques. And then investment volatility and low savings yields for money market, CDs, and equivalent accounts, treasury bonds, treasury yields, make certain gift types with a fixed income more attractive. All right, next slide. Next slide, please. Okay, thank you. So planning opportunities for the current environment. Charitable lead trusts and grantor retained annuity trusts. You may be familiar with GRATs and CLATs if you've been doing planning for clients who have taxable estates, estate taxable estates, and this is a great way to take advantage of the difference between that Section 7520 rate and the degree to which you expect those assets to grow. It's an estate tax freeze technique that's really used to leverage existing estate and gift tax exemption. And as I said, you can really have some additional leverage if you use depreciated or discounted assets, like in a family limited partnership, or in or using assets that might have some lack of control or marketability discounts. That the results can be even more dramatic for transferring large amounts of wealth to lower generations at a minimal transfer tax cost. And then if you use a charitable lead annuity trust, you also can offset that income if you structure it a certain way so that the trust is taxable to the grantor or the donor, that they pay the taxes on it. Then they'd also be eligible for an income tax deduction in the year of the gift or the transfer, which can help offset high income if they have that. We'll talk a little bit about gifts of real property with a retained life estate. Similarly, that's a section 7520 rate play where with a very low rate, it has some very attractive charitable deductions for that. And then even though this is not a technique where you get a larger charitable deduction, but a charitable gift annuity can be a really great solution for people who are worried about their income stream and also are charitably inclined. There are commercial annuities too, of course, which can have higher payouts, but then there's no gift to charity. The gift is essentially the profit for the life insurance company or the annuity company. But if someone is planning on making a charitable bequest, or if they are otherwise charitably inclined and they're looking for additional income, a charitable gift annuity is a great idea right now. And we'll talk a little bit about charitable gift annuity rates in a moment. Okay, next slide, please. Changing approaches to estate and financial planning. All right, next, Christine. Thank you. Traditional estate and financial planning, what does that look like? Well, when I started practicing estate planning years ago, I think there were some general assumptions that were built into how we approached client work. And of course, you know, we like to think that we treat each client as an individual and we address their individual circumstances, which, you know, we do try to do, and that's really important. But as it turns out, based on how our forms are structured and just the process that we have in place, it ends up being more of a transactional process than we might otherwise like. You know, we have the donors or the clients fill out a questionnaire and they provide their asset information, and we take a look, and when they come in for that initial meeting, or maybe it's the second meeting if they came in to meet us the first time, we have some recommendations for them. We say, okay, based on your circumstances and your situation, here's what I'd suggest. And largely that's based on the assumption that unless they tell you otherwise, they want to give as much as possible to their children and grandchildren with minimal transfer tax costs. And not that there's anything inherently wrong with that, except that it usually doesn't reflect what most people ideally would want if given all of the options. They just don't know what the options are, and they're looking to you to tell them what they should do or what are my options. So if we're presenting them essentially with a plan that says here's the way to get, you know, as much as possible to your children and grandchildren at minimal transfer tax costs, most of the time they'll say, okay, that sounds great, thanks. And the result is that they will have a plan that has, you know, well executed documents that do exactly what they're intended to do and are perfectly legal, but that's about it. And also there is some incentive for efficiency at play here too. We have you know, our concerns about our clients wanting to hire us again, and if the fees are too high, they're not going to do that. So we have an incentive to make the process as efficient and as quick as possible. And when we bill on an hourly basis, we don't want to be spending too many hours with them unless, of course, they're a client who isn't at all fee sensitive. And in that case, if you have clients who aren't fee sensitive, congratulations, hold on to them at all costs. But most of us, I think, have experienced cases where even with those clients who have very, very large resources, they tend to look at those the financial planning and estate planning bills closely and say, well, why did it take this long to do this? Or I can't believe it took that much time to do this work, even though it's probably a fraction of what they maybe spent on a vacation or some shiny new toy or a home improvement project. Notwithstanding that the work that you did is directing the largest financial transaction that they'll ever engage in their life, and making sure that that's done the right way. So I think it's important to convey the value of the services too. But the fact of the matter is that there's an incentive to be efficient. And if you're charging a flat fee, you still have that incentive, because the more time you spend on something, the less you're making on an hourly basis, and the less time you can devote to other clients and other activities. Whereas the less time you spend on it, the higher return it is. So in the traditional model, there is that efficiency incentive built in. But I wonder if that really serves our clients in the best way possible. So if you'll go to the next slide, please, Christine. I'd like you to maybe consider a couple of components of a newer approach, values-based estate planning. Now, again, this does not imply that the way that everyone's practicing right now, it does not have a values-based approach, because you do want to consider what your client's values are. And I think many times donors do ask what's important to you, what's, do you want to include any charities in your plan? But because of this efficiency incentive, people feel put on the spot. They're on the clock. And so they don't have a lot of time to sit back and reflect and think and have deep conversations about what's important to them. And so they end up with basically a variation of whatever the first draft was that was put in front of them. So this values-based approach is one that focuses on the client's story and values. It really looks at what's been important to them throughout their life, and how would they like their legacy to reflect that. There's a process through a firm called Thompson & Associates, of which I'm a representative out of Brentwood, Tennessee, and they do work basically for nonprofit clients who hire them to come in to do this values-based estate planning process for their donors and supporters, their strongest supporters. And we're in about 33 states across the country. There are several clients in Minnesota, both in the Twin Cities, and who I work with, and then some in central and western, northwestern Minnesota, Sioux Falls area. Centricare is one that I think a lot of you might be familiar with, that they've done this program or this process for a number of years. Sanford Health has been a Thompson client for many years as well. St. John's and St. Ben's are a client that I'm just starting up working with just in the last few months here. And then in South Dakota, again, Sanford is another one there. So you may be somewhat familiar with this process if you've had clients who have gone through it, or maybe you've gone through it yourself. But this process is designed essentially to answer 3 specific questions. And the first one is, do I feel like I have enough to live off of for the rest of my life? Secondly, what do I want to do for my family? And then third, once I've taken care of those things, what do I want to do with the rest, to the extent that there are other assets available? So it's a little bit different default assumption. The default assumption is not that the donor wants to get as much as possible to lower generations, and the primary motivator being minimal transfer tax costs. And that is certainly what some donors want. There's no question that is what some clients want to do. But when you really ask people about what's important to them, I think you get a little bit different answer. And one way to approach that, or to think about it, is when you're meeting with a client, and I'd recommend or suggest that you just try this a couple times and see how it goes. In your initial meetings with your clients, or maybe it's your second meeting, you'd ask, if you had a large sum of money, and you can define large sum of money in any way you want, maybe for some people it's $200,000, for others it's $1 million, maybe for others it's 20 million or 50 million, or whatever it is. If you had a large sum of money to distribute, and the only 2 rules are that you can't spend it on yourself and you have to get rid of it right now, what would you do with it? And let them think about that and then answer. And I think the response that you will not get is, I want to give it all to my kids, or I want to give 2/3 of it to my kids and 1/3 to taxes. That's just not how most people would answer. I think, many people would say, well, I'd like to give some to my kids and my other family members, my grandchildren. I'd like to do something nice for them. I'd probably give some to my church. We've tithed for however many years, so I'd like to give at least that much to my church. And community giving does a great job. Their local community foundation is doing really great work, and I want to support our community, so I'd give some there. The hospital that treated my daughter did great work, and I want to make that possible for other people, so I'd probably give some to the hospital. And my alma mater, that's what we've given there every year for the last 20 years, and I want to support that. And we listen to public radio and public television all the time, and so we want a little bit to go there. So very often the answer to that question about, if you had to give away a large sum of money right now, you can't spend it on yourself, and you have to get rid of it now, what would you do with it, elicits different answers than give everything to my kids and pay some tax if you have to. And and so the next follow-up question, once they've answered, given their response to that question, is, okay, does your estate plan say to do that? And if not, why not? And we all know that we're creative planners. We can find ways to give people the results that they want if we know what they really want. So that's really what this is about, is finding out in an ideal world, in a perfect world, what would they want? And many times uncertainty is a part of that. They don't know how much is going to their kids. They don't know how much is going to taxes. And I've found that financial planners, financial advisors, wealth managers tend, I think on average, I don't want to make broad generalizations, but I've seen many financial advisors do this better than estate planning attorneys or accountants. And I love estate planning attorneys. I have been one, and I love accountants. But I think financial advisors, maybe it's just the training that they get or the method in which they practice. But they do a better job of illustrating, here's how things are going to flow. So I'd also suggest that this values-based approach is one that shows donors what their current plan does before you make any decisions about what you want their new plan or updated plan or first plan to do. And if they don't have a plan in place, the current plan is what state law says happens to the assets. So this values-based approach, you'd have people fill out an in-depth, thoughtful questionnaire that tries to get at some of their values, and then we create a statement of values and objectives. And that, in conjunction with a comprehensive net worth statement, allows us to put together an illustration, and you can do that in various forms. It can be in flow charts or pie charts, but a spreadsheet is often the most helpful, where in one column you show, okay, here's how much you have going to under your current plan. Here's how much there is going to family. Here's how much going to charity. Here's how much going to taxes. And most people don't have charitable provisions in their plan currently. And you think about that disconnect, where I think it's about 80% of Americans make some sort of gift each year to some organization, to some cause, and yet fewer than 10% seem to have charity included in their estate plans. And we know as professional advisors that only about half of all adult Americans even have an estate plan to begin with. And then those who do have a plan, somewhere, I've seen various numbers, but somewhere around the range of 6% to 10% include charitable gifts as part of their plan in the current environment. And I think that strikes me as way too low, given what people feel and what their actions are during their lifetime. So then after that, they can see with their current plan how much they've got going to family, how much they've got going to charity, how much going to taxes. Usually it's some percentage, and maybe it's 65, 70, 80% going to family and 20% going to taxes. And by the way, you might be thinking, well, wait a minute, most of my clients aren't subject to estate taxes. Now with the new exemption equivalents of over 11.5 million for individuals, or 23 million per couple, 11.58 million per individual, and the Minnesota estate tax exemption level being at $3 million per person. And if you do the proper planning, you can exclude $6 million of gifts to individuals from Minnesota estate tax. I think the assumption is, well, we don't have to worry about estate taxes. Well, for one thing, many of us do work with clients where most of our clients don't have to worry about estate taxes, but many do. There still are a large number of people out there, and many of them are large charitable contributors who will be subject to estate tax, and so that's something to address. But the bigger thing is income tax considerations with respect to IRD assets, income in respect of decedents, which is mostly retirement account funds, qualified retirement accounts, IRAs, 401ks, 403bs, 401as, where a large number of our clients have substantial retirement accounts and don't realize that when those get distributed out to individuals, that's going to be taxed at the highest marginal income tax rate for the recipient. So we show in those plans not just the estate tax ramifications, but the income tax implications of those retirement account assets and other IRD assets being distributed out to family members. So it does two things. When people see those numbers for the first time, they'll often have one of two reactions. One, I didn't realize my kids were getting so much. And that's because a lot of times when we're thinking about what we have, we're thinking about what we have in spendable assets. So we've got our checking accounts, we might have brokerage, stock accounts, things are liquid assets, but we're not thinking about the death benefit of life insurance policies, where we're not using that during our life, but when we pass away, that's going to be distributed to someone. Also, our homes, we might tap into our home equity. We're actually trying to go through a mortgage refinance ourselves right now, so I know all about that. And so you consider that as an asset to some extent, but when you pass away, you've got that home to sell, and the proceeds after any debt is paid off will go somewhere. You've got retirement accounts, which people have been tucking away money for retirement and for a rainy day, and don't want to touch that if they can at all avoid it until they absolutely need it. And so they're not considering that as spendable assets. But when they pass away, they won't need it anymore. And so that's going to go somewhere. So when you add up all these assets, a lot of folks have never seen in one place how much is really going to their family. And often the reaction is that's a lot more than I anticipated. So they may have been worried about what could I leave to my kids, but when they actually see the amount that would be going there, they realize, well, maybe they don't need that much. If there's $1 million going to each kid or $2 million going to each kid, that might be what many clients want. And I've worked with many clients and donors where they have higher amounts that they want to go to the kids. But I've also worked with folks who said, you know what, if they got $400,000, they would be thrilled. And many times the children are doing as well as the parents are and really don't need that income. So they certainly want to remember them and include them as part of their planning. But when they see that they're giving $2 million to their children and nothing to charity, that strikes them. And they said, well, that's not who we are as people. So I would highly encourage doing those flow charts, those illustrations for donors before you do their planning. The second thing is asking about what's been important to them during their lives and throughout their lives, and giving them some time to breathe and to think without being on the clock. I know that's really difficult to do as a professional advisor who might get paid by the hour, or you get paid a flat fee, and so the more time you put into it, the less lucrative it is. But I think it's really a valuable, important thing for clients to have a little bit of time when they're not worried about how much is this costing me to do this. So this is a personal process where we can line up what people say is their ideal with, oh, I give this much to my church or synagogue, and this much or mosque, and this much to my favorite hospital, and this much to my community foundation, this much to my alma mater, this much to other arts organizations, public media, whatever. That you can incorporate that planning into their plan, and they'll be really excited at the results. And as we know, charitable planning often leads to tax reduction. So if people have a choice of would I rather give my kids another 60 cents and the government another 40 cents in taxes, or give $1 to my favorite charity, they very often say, well, my kids, after they've received a certain amount, they're taken care of, I would rather give that $1 to charity. So you're adding value for them, because the end result is that they feel really, really good about what they're doing. It's exciting for people who never thought of themselves as major donors or philanthropists to realize that they can be, and you're helping them do that. So that actually tightens your relationship and makes you more valuable to them as they're navigating this process and coming up with a plan that more closely reflects who they are as people or individuals. So you have, the results are, you've got a plan that is in line with their values and is really meaningful and makes them feel good beyond just the relief of okay, I've got something in place should something happen. Also, by the way, part of this is non-financial, so it's not just all about the money. As part of the Thompson values-based estate planning process, we encourage the people who go through the process to write letters to loved ones, and very often this is to spouses and or children and grandchildren, and we encourage them to write these letters to their loved ones to tell them what they mean to them, what they'd like to leave in terms of values, what they think is important, and what they'd like them to know about the writer's life. And that for many people can be as meaningful or more important than the financial side. You know, of course, the financial and legal side is very important, but this transmission of legacy and what's your personal story, why do you feel the way you do, why have you made some of the decisions that you've made, can be really powerful too. So that's another thing that's part of this process. Oh, and by the way, with this values-based estate planning process that I've been talking about that happens through the nonprofit organizations, that's at no charge to the donors. And what we do is, you know, we're not providing legal or tax or financial advice to those folks. We're simply consultants. So it'd be acting as an estate planning coach, an estate planning guide to walk them through some of these conversations. And at the end of the day, we give them a packet of planning recommendations based on the conversations we've had to give them, to send them out to you, to their estate planning attorneys, their accountants, their financial advisors, to actually have implemented. So we know it's important to send them to you in a local advisor community to get that service, that legal advice, the tax advice, the financial advice that they really need. So we also make sure that they utilize you to the extent that they're able, and then work with those advisors in the implementation if there are any questions. And sometimes the plan that comes out of the advisor's review is a little different, or, you know, significantly different. That's perfectly fine. But the point is that you're moving them from inaction to action. That you know, they may have dragged their feet on doing a plan until much later in life than they anticipated, and this provides a discipline or a reason for them to take steps forward each month over a course of several months. So that's something important to know about it too. And the results are really fun to see, where for the firm with which I work on this, they've done an analysis of the planning clients who have gone through, many of whom are in Minnesota, over the past 4 years. And of them, it was determined that at the beginning of the process, there were 3% of planning clients who had already in their plans a gift for the sponsoring nonprofit, and 6% of the people who started this process had a gift to charity of any sort. At the end of the process, after it was completed, 54%, so over half, included a gift to the sponsoring nonprofit, and that wasn't there before. And or I think that includes ones that were there before that, 3%, but it increased by over 50%. And about 2/3, 66, 67% of people included a charity of some kind in their plan. So you can see some pretty dramatic results for charity in the community through a values-based approach, and you help make that possible when you facilitate it. So just wanted to give you a couple things to think about, maybe some ideas you can incorporate into your own practice. I mean, maybe if you have a chance to go through this process yourselves as part of one of those sponsoring organizations, a supporter or board member of those organizations, I'd encourage you to do that too, because I think it really can make a difference for the client base. And so whenever I'm in front of professional advisors in the community, I try to encourage them to take some of these steps or try to incorporate some of these into your own process. And maybe you're already doing some or all of this already, in which case I think that's fantastic. Okay, next slide, please. We'll talk now, we'll shift a little bit into plan giving context and basics. And if you go to the next slide, please, Christine. So this slide talks about what charitable giving looks like in the United States writ large. The Giving USA 2019 report reports on gifts in 2018. That comes out usually in June of every year. I don't know, with the turmoil we've had this year, if it's still going to come out next month, or if it'll be a little bit delayed. But the last report came out last June looking at numbers for 2018. And in 2018, there's about $428 billion, $427.71 billion in total charitable gifts. And the way that breaks down is gifts from individuals, which is the vast majority of these, $292 billion, gifts from foundations, gifts to foundations. Gifts from foundations, $76 billion. Gifts from bequests, about $40 billion, $39.71 billion, and gifts from corporations, about $20 billion. If you aggregate those bequests and individual gifts, because bequests are gifts from individuals, you'll see that bequests are really about 12% of all individual gifts, about 11.97% of gifts in 2018. And this is important for charities especially to consider, because for those nonprofits out there who are receiving more than 12% of their overall charitable gift revenue from individuals by bequest, you're doing great. You're above average, and keep doing what you're doing, and maybe do some things to tweak that, increase that further. For those organizations with whom I work, and the amount that they receive of their annual individual charitable gift revenue is less than 12% from bequests, that's also great in that they have a lot of opportunity, a lot of room to grow, and that there are some things that they can do to increase that, because donors are making gifts by bequest, and if the organizations aren't asking for those from their donors, other organizations are. So there's going to be a bigger share going to the organizations who are making those requests from their donors and working on building those relationships and making it known that those are gifts that organizations want and need. But I just wanted to show you this just so you get a general feel of the context or the scope or the scale of charitable contributions. And one thing to note is that typically there's a strong correlation between GDP and charitable giving. There's a gentleman named Bob Sharp, who's out of Memphis, Tennessee, who's done a lot of research and analysis through his firm, the Sharp Group, where he has shown, going back past the Great Depression, for as long as we can find charitable giving records, the annual charitable gifts and GDP and tracking those, and it's usually right around 2%. So I have a feeling that charitable giving, the much bigger gifts are going to be down when the 2020 numbers come out, just because the same sort of resources aren't available. But it's really interesting to see that as GDP and the economy goes up, that charitable giving goes up, and as that goes down, charitable giving goes down too. And it's been really interesting to me that there hasn't been a lot of variation from that 2% number. And sometimes it's 0.3% up or down in a given year or over a given time period, but mostly it sticks pretty flat at that percentage of GDP. So that means that when the economy is doing well, charitable giving generally is doing well, and B, what if we were able to make a change in some way so that even tweaked up 0.5% or 1% of GDP? That would make a huge difference for public benefit in our society. Okay, next slide. Talk about different types of planned gifts. I think all of you are familiar with bequests, will and revocable trust provisions, beneficiary designations, which can include various qualified retirement accounts like IRAs, 401ks, 403bs, 401as, 457 plans, beneficiary designations for life insurance, and POD designations for bank accounts, and TOD designations for brokerage accounts. Next slide. Life income gifts, which we'll talk a little bit more in a moment. Those are mostly charitable gift annuities, which come in a couple different types, immediate and deferred. Immediate being a gift where the distributions start within a year, and deferred being a charitable gift annuity that's set up where the distributions start more than a year out. And then charitable remainder trusts, which can be a couple different forms. It can pay out an annuity, a CRAT, a charitable remainder annuity trust, or it can pay out a flat percentage of the trust revalued annually. That's a charitable remainder unit trust or a CRUT. Okay, next slide. So important in understanding some of these calculations and how we determine things like charitable deductions and present value of annuity interests. It's important to know about the Section 7520 rate. And as advisors, I think all of you are aware of that, but for others who may be on the line who aren't as familiar with it, the Section 7520 rate, sometimes called the AFR, the applicable federal rate, it's the rate that's used to determine, that's used in the calculation of the present value of annuities, remainder interests, and life estate for gift valuation and determining charitable deductions. It's essentially the rate at which the IRS is assuming in a given month that assets are determined to grow throughout the life of the vehicle or the term that's at issue. So of course, the IRS knows and we know that that those asset values are going to fluctuate over time, but you have to have some number for calculation. And so this is based on 120% of the applicable federal midterm rate rounded to the nearest 0.2%. And in this context, the federal midterm rate is the rate that's used for valuing loans of more than 3 and up to 9 years. So that's just what they chose, how to define this rate. Next slide. So this is updated monthly by the service. There's a revenue ruling that's published about the 3rd week of each month, usually around the 18th. So the new AFR Section 7520 rate for June should be coming out next week if things aren't delayed. And it's ranged from a high of 11.6%, that was back in 1989 in May, to a low of 0.8%, and that's right now. If you'll notice, that's May of 2020. We are in historic territory where it's never dropped this low before. It's hit 1% a couple of times in late 2012, early 2013, but it's never been this low before. And for that reason, as we'll see in a moment, it can be a good time to take advantage of a couple different techniques. In the last couple of decades, it's gotten as high as 8%. I think actually in March of 2000, it was 8.2%. I used April because I prepared the slide last month, but you can kind of get a sense of the range and how much it can fluctuate over time. And one thing to know is that if a donor is making a charitable gift that involves an AFR calculation or a Section 7520 rate calculation, they can make an election to use in that calculation the applicable federal rate for the current month, the month in which they're making the gift, or either of the 2 prior months. So sometimes you can take advantage of a higher rate or a lower rate to get the result that you want. Okay, next slide. So now that we've had that bit of a primer on Section 7520 rate, I want to talk a little bit about charitable gift annuities. So this is something that a lot of development officers are familiar with, and that professional advisors, the accountants, the attorneys, the financial advisors may be a little less familiar with. And the reason is that it doesn't necessarily require an attorney to draft this document, and these are transactions that donors are doing directly with the charity. We urge them to seek professional advice when these illustrations are made and when they're being solicited and contemplated. Sometimes they do seek out the advice of their accountant or lawyer or whoever, but often these are simply financial transactions between the donor and the charity. And the way it works is that the donor will give some asset, could be cash, could be appreciated stock, or other assets, to the charity in exchange for the charity's promise to pay them a fixed amount, an annuity, for the rest of their life or lives. And actually, you can designate someone else as the annuitant. There are some potential gift tax implications of that. Usually it's the donor themselves, or the donor and a spouse, or a spouse for whom it's set up. But sometimes people will set them up for parents or children or a sibling or whoever. And so it's a promise to pay that annuitant a fixed amount for the annuitant's life, and it could be 1 or 2 lives. And at the end of the annuitant's life or lives, whatever's left of that goes to benefit the charity. The charity can use it for the designated purpose, or if there was no designated purpose, for whatever they want. I'd like to note that even though this is something that a lot of advisors aren't that familiar with, it actually has a long history. In fact, the first gift annuity was established in 1831 when an artist named John Turnbull, and he actually is a famous Revolutionary War artist, and you've probably seen some of his paintings or replications of his paintings somewhere. He contributed to Yale College a bunch of his artwork in exchange for a lifetime annuity. So it goes all the way back to almost 200 years ago. And my understanding is that the Turnbull Gallery is still there. So Yale's still benefiting from that gift, in which it promised to pay John Turnbull a fixed amount for the rest of his life. There's an organization called the American Bible Society in New York City that is the longest continuously operating charitable gift annuity program in the country. And on your website, if you go there, you'll see that they kind of proudly note that they've been doing this for over 170 years, or about 170 years. They made their first charitable gift annuity payment in 1843, and as they note, we haven't missed a payment since. So this is a program that's been in operation through Civil War, through a couple world wars, and other upheavals, the Great Depression, you know, the various recessions we've had throughout the years, and it's a type of gift that has been really beneficial for donors. As long as you've got a solvent organization that has strong finances, it can be a really great deal for donors. So let's see a little bit about what this looks like in operation, or how it works. How are these payout rates set? Well, there is an organization called the American Council on Gift Annuities, and there's a link to the website if you want to see more about the rates and the decision-making process in the slides. But the way it works is essentially the older the annuitant, the higher gift annuity rate. So that's true for commercial annuities too. And as I mentioned before, commercial annuity rates tend to be a little bit higher, but that's because there's no charitable gift included. So for a donor who doesn't care at all about charity, you know, they could do a commercial annuity, and then the gift, or the profit essentially, just goes to the life insurance company or the annuity company. But for donors who are charitably inclined, this can be a really great tool. But the older, the general thing to remember is the older the annuitant, the higher the gift annuity rate. They set their rates based on prevalent economic conditions and interest rates, and they adjust them from time to time. And they have essentially a gross investment return expectation that's pretty conservative. They assume 4.25%, and the ultimate assumption is that if it's invested that way and you make distributions based on these rates, that there will be a 50% residuum. So basically 50% of the original contributed amount will go to benefit charity at the end of the term, or at the end of the donor's lives. As practical result, most of the time when these are invested, they earn more than that 4.25%, and so very often the amount that ends up going to charity is equal to or greater than the amount originally contributed. Now, if that doesn't always happen, and you know, if a donor makes one of these gifts at the peak of the market and then it tanks, these can get underwater. But it's an obligation, it's an ongoing obligation of the charity, of the nonprofit that's issuing them, to make these payments no matter what. And it's something that is not limited to the value of the original contribution, and once that's gone, it's exhausted. It's something that the charity is on the hook to pay as long as they're in existence. So I know that your community giving, your local area community foundation has a lot of experience with these, and is in a strong financial position to offer these to your clients if you're looking for someone to issue those. You have to be careful about where you're soliciting them, because you have to be registered in the state in which you're soliciting and issuing these gift annuities. And different states have different registration requirements. Minnesota's requirements are pretty simple. North Dakota has a little bit more stringent policies. So if you have donors in North Dakota, you want to take that into consideration. I'm not sure what South Dakota's policies are, but the thing to note is you have to be registered in the state where you're issuing those. As I said, the rates are updated in response to market conditions. They were just lowered a little bit last winter, effective January 1st. And we've seen updates recently that the ACGA Rates Committee, typically they meet in April. They just met again last week and announced that they are going to be decreasing the published gift annuity rates, which most charities follow. The charity is not bound to follow that, but they're recommended maximum rates that almost all charities who issue these gift annuities follow. That they're going to be decreasing the rates somewhere in the range of 0.3 to 0.5%. So just to give you a sense, normally these rates range from about 4% to about 9%, depending on whether it's 1 or 2 lives and depending on the age of the annuitant. But those rates are going to be going down a little bit effective July 1st. So the takeaway from that is that if you're working with clients for whom you think this might be an option, you're working with donors for whom you think this might be attractive, they can get a higher payout probably if they're able to make the gift and make this transaction before July 1st. So that's something to be aware of. Okay, next slide. Here we've just got an illustration of what this looks like. This is something that might be put in front of a donor. There's commercially available software that can do the calculations for you. One is called Crescendo. They're based in Camarillo, California. That's what this illustration is from. There's another organization in well, it's in a couple places on both coasts, but based in Boston, called PG Calc, that has similar software. Both of them are widely used. But just to show you what this looks like, in this case, the donor made a cash contribution to, let's say, the community giving, Central Minnesota Community Foundation, and gave $50,000 in exchange for this agreement to pay a 5% annuity. So this is Ole and Lena Larson. They're a 75-year-old married couple. So their rate at age 75 is 5%. So they make this $50,000 contribution of principal. In exchange for that, they get $2,500 for life from the Central Minnesota Community Foundation. And of that, there's a breakdown where $2,120 of that $2,500 is tax-free, and that's because that's considered return of principal or return of investment on the contract that's spread out over their life expectancies. So once they reach their life expectancy, which I think in this case is just a little over 20 years, then the rest of the payments are ordinary income. But as I like to say, that's a good problem to have, because that means you've outlived your life expectancy. There's also, by the way, kind of a running joke among charitable gift planners that the best way to increase your life expectancy is to take out a charitable gift annuity, because it seems like donors who do this live much longer than their life expectancy. And of course, you want people to live long, happy lives, and you don't wish anybody an earlier, untimely demise. But the longer it goes, usually, depending on what the market's doing, the longer the charity has to wait for the gift, and the amount could go down or whatever. So it's just kind of a funny joke. But there is some research to back that up, that people who do have gift annuities do tend to live longer than the actuarial mortality tables might indicate. But it'd be facetious to say that it's because of taking out the charitable gift annuity. There are other factors at play, like economic circumstances and social support networks and access to healthcare, and I think all sorts of other fun variables. But that is a joke you'll hear every once in a while. So once the donor passes away, over that time period, let's say they live to their full life expectancy, they get $51,000 in payouts from that annuity over that term. And then at the end of their lives, there's $50,000 here in the illustration that would go to benefit the community, the Central Minnesota Community Foundation, or Wilmer, or Alexandria, or Brainerd, or wherever you are. So this can be really attractive. It's actually a pretty simple tool. So just to note again, $380 of that $2,500 payment for the life expectancy of the donors would be ordinary income, and the rest would be tax-free return of principal. Okay, next slide. Similar, there's a life income gift called charitable remainder trust. Now, this is something that I'm guessing that most of you in the legal and tax and accounting community, financial advisor community are more familiar with. It's a similar concept to a charitable gift annuity, but instead of contributing property to the issuing charity, you're contributing property to a trustee who holds the assets in trust. The individual is the income beneficiary. Again, that can be an annuity, a fixed amount paid for life or a term of years, or it can be a charitable remainder unit trust, a CRUT, which pays out the fixed percentage. Given the choice between those, given that gift annuity is an alternative to an annuity trust, we don't see that many charitable remainder annuity trusts, and that's for a couple of reasons. They largely accomplish the same things in most circumstances. The gift annuity is easier to set up. It's usually like about a 2-page document as opposed to a trust agreement. You don't have to pay an attorney to draft the agreement, the trust agreement, like you would with the CRAT. There's not the ongoing administrative expense that the trustee would charge. In the case of a gift annuity, it's an operating expense that the charity just incurs as a cost of doing business. So it's cheaper, it's simpler, it's faster. There are some circumstances where a CRAT might be appropriate, where maybe you have more than 2 income beneficiaries who you want to benefit, or maybe you have multiple remainder beneficiaries and not all of them offer a charitable gift annuities. Then you might want to use a CRAT. But most of the time, given the choice between those two, people will choose a gift annuity. On the other hand, many times donors will choose a charitable remainder unit trust for various reasons. One is that it's a bit of a hedge against inflation. There's some upside. There's some upside potential, and so as the trust grows, hopefully in value, the payouts also will grow, and in that context, it's also important to remember that there is some downside risk. So the market, as we know, doesn't always go up. So that's important to let clients and donors know that things don't go up all the time. And so there is a chance that their payouts could decrease. But given the general increase in market values of most well-invested charitable remainder trusts, it can be a really good deal for both the donor and the charity. There are different subtypes of charitable remainder unit trusts. One is a standard CRUT, which simply pays out the flat percentage every year, revalued annually. There's also a net income CRUT or a NICRUT that pays the lesser of the net income of the trust or the standard or the designated unit trust amount percentage. So, for example, if there's a 5% unit trust and it actually has, and it's a net income CRUT, and it has net income of 1%, it would pay out that 1% rather than the 5%. And there's a variation of that called a net income CRUT with a makeup provision, or a NIM CRUT, which is the same thing as a NICRUT, but it also says keep track of the difference between that net income from year to year and that standard payout amount. So in that example, if you've got a 5% CRUT that's a NIM CRUT, and it has net income of 1% in the first year. That first year would pay out 1%, but then let's say in the next year it had 10% income. It would say to the extent you have extra income above that 5% unit trust payment, make up the difference from the prior year's deficits when you do have more income. So that's a variation on that. And then the last type is called a flip CRUT. And that's essentially starts out as a net income CRUT, where it pays out the lower of the net income or the standard unit trust amount. And then at the occurrence of some event called the flip trigger, it flips over to a standard CRUT. So the way that might work, let's say a donor puts in, contributes a piece of real estate to a charitable remainder unit trust. And it's low income producing, maybe it produces 1% or 2% of income from that property. But eventually they want to sell that property and diversify and get a higher payout. Well, you don't want to have to be paying out 5% right away if it's only generating 2%, because that means you're distributing out fractional interests of the property, which would not be a good result for anyone. And so it starts out as a net income trust, so it pays out that 1 or 2% until the property sells, and that's defined as the triggering event in the trust document. And then the next tax accounting year, calendar year, it flips over to a standard unit trust where it will pay out that 5% once the trustee is able to diversify those assets and has more liquid assets. So that can be really useful in a couple of different situations. Okay, next slide, please. Christine, next. Oh, okay, thank you. Okay, you got it. So there, this is an illustration of what a charitable remainder unit trust might look like. And in this case, we're assuming that the donor contributes the asset to the trust, and here it's appreciated stock. So it's got a value of $500,000. There's a basis of $200,000. So there's some capital gain in there. And one of the benefits here is that you can bypass that capital gain by giving it to this charitable remainder unit trust, which is a tax exempt entity. And in addition to current income tax deduction based on that Section 7520 rate, in this case, the assumption is, let's say the donor is in the 24% federal income tax bracket, and they make that gift in this month in May with a pretty low AFR, they would still get a charitable deduction of $245,000, $245,645 for that contribution, which is basically the value of that property transferred, that $500,000, minus the actuarial value of the of the income interest, that 5% unit trust interest valued based on that AFR. So they'd still get that $245,000, $246,000 income tax deduction that if they're in a 24% federal rate would save them $58,955. And that's assuming that they're in a state with no state income tax. If you're in Minnesota, for example, you'd have additional tax savings. Plus, you get to bypass some of that capital gain. So let's say they're in the 15% capital gains tax bracket. Normally, if they sold that property, they'd have a $300,000 gain, which at 15% would be an additional $45,000 in taxes that they don't have to pay by doing it this way. So then over the course of their 2 lives, they would get annual income of $500,000 in the first year, times 5% is $25,000 in the first year. And then over time, that amount will go up or down depending on what the trust does. In this illustration, we assume that it has a 7% trust return. So it's earning 7%, distributing out 5%, so essentially growing by 2% a year on average. Over their estimated lifetimes of 20.4%, or 20.4 years, their estimated life expectancy, they would receive over $622,000 from this unit trust in payments. And then at the end of the day, after they've passed away, there's about $750,000 that would go to, say, the Willmar Area Community Foundation to be used as designated by the donors and to help organizations and people in that community. So that can be really powerful. And then there's also a tax breakdown for these assets too, where part of it is a 4-tier accounting system really for CRUTs, where first the ordinary income comes out, then any capital gains, and then tax-free income like bonds, muni bonds income, that sort of thing, and then tax-free return of principal. All right, next slide. So now switching over to, finishing up with a little bit of a review. Other plan gifts involve gifts of real estate. You can make outright gifts of real estate to charity. You can do that either lifetime by just deeding the real estate to the charity if it's willing to accept it. I know that the Minnesota Real Estate Foundation, which is an initiative of community giving, and the Central Minnesota Real Estate Foundation, and Central Minnesota Community Foundation has done great work in this area. And if you've got clients who have real estate that they might be able to consider for a charitable gift, I would urge you to talk with Steve or some of the executive directors about that option and how they might be able to help. You also can leave gifts of real estate through a will or revocable trust agreement at death as a testamentary gift. There, you can do in Minnesota and many other states a transfer on death deed, as we'll take a look in a second, which is a revocable transfer. The donor actually has you as the attorney, and I'm speaking to the attorneys now, to draft the deed, and it gets recorded in the county. And I think many of you have done these for your clients, maybe for charity or for family members or for other purposes. And then upon the donor's death, unless they've revoked that or filed a subsequent transfer on death deed with a different designated beneficiary, the beneficiary on the transfer and death deed becomes the legal owner of the property. And then there's a technique called a remainder interest with a retained life estate, where the donor contributes to real estate but retains the right to live in and use the property for their life. That's really advantageous in this low interest rate environment, which we'll go over in an illustration shortly. Other types, charitable lead trusts, we'll talk about that a little bit. Gifts of closely held business interests, mineral rights, oil, gas, and mineral property, tangible personal property, and that can be a variety of things. It could be vehicles, valuable vehicles. It could be jewelry. It could be artwork or valuable musical instruments, and then also gifts of crops, livestock, and farm equipment. All these are different types of plan gifts that can be made, or assets that can be used for plan gifts. Okay, next slide, please. So the charitable lead trust, many of you have heard about charitable lead trusts. I don't know how many have drafted them. I was involved in the drafting of some when I was in practice working at Dorsey. In the field as a charitable gift planner, I have encountered very few charitable lead trusts, and I kind of scratch my head about this, because when interest rates are low, as they have been quite a bit over the past few years, especially in 2012, 2013, and then now currently, you'd expect to maybe see more of them just because it makes so much sense from a tax perspective. Well, I think one issue is the increased exemption levels for clients and donors, that fewer people have taxable estates. I mean, it's largely used for leveraging estate and gift tax exemption and a way to freeze asset values for those people who have taxable estates and to transfer those assets in an efficient way to lower generations. So I think just the fact that there are fewer people who have taxable estates means something of a decrease in them. But I think because they are in use and people are drafting them, you wonder why aren't we seeing more of those from a nonprofit standpoint? And I asked a couple of estate planning attorney friends of mine about this, and they said, well, we are drafting them, but largely the beneficiaries that they've been drafting those for are private foundations. So that was a partial explanation of why we might not be seeing so many of those in the field as charitable gift plan nonprofit development folks. Is that perhaps donors are doing these more for private charities, but certainly they can be used for public charities. And I know when I was at Minnesota Public Radio and the University of Minnesota Foundation, we had donors who set up charitable lead trusts that benefited those organizations, and they can be great tools. So the way it works, it's essentially the inverse, the opposite of a charitable remainder trust, that it's a gift where the donor contributes property to a trustee, and instead of the individual being the income beneficiary, it's charity that's the income or lead beneficiary. And then the remainder, rather than being a charity in a charitable remainder trust, the remainder is individuals or trusts for the individual's benefits, usually children of the donor. And it can be either an annuity trust or a unit trust, so it can pay a fixed amount every year, or it can be a unit trust that pays a percentage. And then, again, it's not something we see all the time, but it can be useful for donors subject to estate taxes. Next slide. So here's an example of how something like that might look. Now this is deemed in the Crescendo software, they call it a super trust, annuity lead super trust. What this is, it's a charitable lead annuity trust that is a non-reversionary, meaning that the donor doesn't get the assets back at the end, grantor trust. And a grantor trust for tax purposes, essentially meaning that it's drafted in such a way that it's not includable in the donor's estate for estate and gift tax purposes, but it is taxable to the grantor for income tax purposes. Well, normally when trusts are set up, you don't want the donor to be liable for the trust's taxes, but in some cases you might want to do that. And the reason being that if the trust has to pay taxes, and remember, a charitable lead trust is not a tax-exempt entity like a charitable remainder trust. It has to pay taxes. If the trust is paying taxes, that's reducing the amount that ultimately will flow out to the remainder beneficiaries, which in this case is family. So if the donor has the wherewithal to be able to pay those taxes during life, it can be set up in such a way that the donor pays those taxes, gets additional assets out of the estate, and the other result of that is that the donor then is eligible for a current income tax deduction. That's the only way that a donor can get an income tax deduction from a CLAT is to do it that way. So in this illustration, the donor has property, we'll say appreciated stock again, that's worth $1 million and has a basis of $500,000. So here, with the calculation using an 8%, a 0.8% AFR, so funded this month in May of 2020. The charitable deduction for that is substantial, and that can lead to income tax savings of $340,633 for that transfer. At the end of, for those 20 years of this trust term, in this case it's a 5% lead trust over 20 years, $1 million will be paid out to the donor's favorite charity. So you could set one of these up for the Brainerd Lakes Area Community Foundation, and the Brainerd Lakes Area Community Foundation then would get $50,000 a year for 20 years from this trust. At the end, you've got a substantial amount that's going to family free of estate and gift tax. And then there's also income tax benefits for the trust donor there too. So Next slide, if you go to it, please. Shows the difference between what would happen if the donor just held on to this property, and this assumes that they've got a federally taxable estate. So they're an individual that has 11.58 million or more, or it's a couple with more than 23 million. So they have a federally taxable estate. This does not take into consideration Minnesota state tax, just to let you know. The combined federal and state estate tax rates, when you do a calculation, which is kind of a circular calculation because you get a deduction for state estate taxes paid, is I think 49.6% is like the marginal, the highest marginal rate for estate taxes when you combine both federal and Minnesota state taxes. This shows just a flat 40% for its estate tax assumptions. But if you're in Minnesota, for example, the savings or the results would be even more pronounced. So here, the donor keeps the property, assume the trust grows or the property grows at 7% a year for 20 years. Then at the end of the day, when the donor passes away, there's about $3 million of that original $1 million, but they have to pay estate taxes of 1.196, almost $1.2 million, that 40% haircut off the top. And again, in Minnesota, you'd have to add on additional estate tax, so you'd probably be looking at about another $120,000 difference there. At the end of the day, you still got 1.8 million going to family here, which is, a good amount to give to family out of that original $1 million. But let's say instead the donor, who's Ole Olson here, decided to set up a charitable lead trust for the Brainerd Lakes Area Community Foundation. And from that, then he'd get an immediate income tax deduction that would have an income tax savings in that current year of $340,000 roughly. And that's because the way that this calculation works, the taxable gift at the end of the day is this $1 million minus the actuarial value of that stream of 5% or $50,000 for 20 years to charity, which in this interest rate environment means a taxable gift of only about $79,000, $79,290, which is what's the imputed or deemed gift to family. So you can either pay gift tax on that, or you can use up some of your estate and gift tax exemption on that, but really it's almost zeroed out. So then for 20 years, the Community Foundation gets this distribution of $50,000 a year. At the end of the day, they've received $1 million. And then in the charitable lead trust, if you assume here that it's growing at 7% and paying out 5%, so you've got about 2% growth per year, then the principal amount to family that's distributed at the end of the year, at the end of the term, is about 1.8 million. So pretty similar amount to family, actually more to family if you assume that there's Minnesota estate tax here, and you've provided this incredible gift to charity. Okay, the next slide, please. Okay, in this illustration, we're showing a little bit different scenario, and this is a grantor trust where the grantor, the donor, is actually retaining a reversionary interest, meaning that the assets are intended to come back to the original donor in the first place. So this is not done at all for estate tax planning purposes. This is really done for income tax planning purposes. And so the scenario here is, let's say that the donor wants to make a $500,000 gift, and so they use cash for that, for example. Maybe their favorite charity has a campaign going right now, and they want to benefit that charity, but they've had a high income year and they want a large deduction to help offset that income in the current year. Well, they could set up a high payout charitable lead trust for a short term. In this case, it was illustrated, it would pay out 20% per year over 5 years. And if it's $500,000, that 20% is $100,000 per year that it pays to charity. The donor gets a current income tax deduction of a significant amount that yields tax savings of $180,000 in the current year. And then the charity gets that distribution of $100,000 a year over 5 years. At the end of the day, whatever's left in the CLAT comes back to the donor. In this case, in this illustration, assuming a 7% return, the donor would get back $126,000 even after having made that that $500,000 gift to charity and receiving that income tax deduction in the first year. So that's another way in which this can be used. Holly, if you wouldn't mind muting, I think we're getting some noise from your end.
Oh, okay. I got on my, yep, hang on. I got on my phone.
All right, thank you. Okay, next slide, please, Christine. All right, now we'll switch over to just take a look with our last segment here, just to look at how different charitable assets, assets a donor or client might own can be used for planning purposes. So next slide. The first one we'll look at is appreciated stock and other long-term capital gain property. And so some preliminary notes I want to make here is that very often donors are being asked for cash gifts. And that's important for an organization's ongoing operations. Cash is easy to transfer, and you don't have to sell it or find a buyer for it. But really, very often, it's not the best gift for the donor to make. And so, especially if a donor is considering a large cash gift, a client's considering a large cash gift, you should take a step back and say, what other assets does this client have that they could use that might have greater tax benefits and save them more money along the way. So I like to do that by showing an illustration here. And so Christine, if you'll just go to the next slide, please. So here we have a donor, let's call her Sally, that she wants to make $1 million gift to the Alexandria Area Community Foundation. And so Sally's got a couple of different assets with which she could make this gift. She's got additional assets, but these are the two that she's identified that she could use to make the gift. $1 million in cash and $1 million in appreciated, say, 3M stock that has a basis of $200,000. So she bought it for $200,000, well more than a year ago, so it's long-term capital gain. But she's got this $800,000 appreciation in it that if she sold it, she'd have to recognize. So she's trying to decide whether to use cash or stock to make the gift. Which should she choose? Now, normally I'd ask for a response from the audience, but because you're all muted and because you probably all know the answer anyway, I'll say that she should use the stock to make the gift rather than the cash. So if you'll advance one more, Christine, this shows a little bit how or why. Let's say she gave the cash. Okay, there's a charitable gift of $1 million. She gets a full fair market value charitable deduction. She's a high income donor where she's in that 37% federal income tax bracket. She would get a deduction for the $1 million, which would save her actually $370,000 in income that she could either use in the current year or take what she can use in the current year for deduction and carry forward the remainder for up to 5 additional years. And in this case, there's no capital gains tax because she hasn't sold any property, appreciated property. So the after-tax cost of the gift is $630,000. So you're making a $1 million gift, conferring a $1 million benefit to the Alexandria Area Community Foundation for a real cost to you of $630,000. Yeah, not bad. But let's say she had instead, or you as her financial advisor or accountant or attorney had said, wait a minute, why don't you use this 3M stock? Their stock price has been increased because they're selling all these N95 masks, and really I don't know what their stock's doing recently, but well, let's just say it's appreciated after all is said and done. And so you still get this full fair market value deduction of $1 million for that, saving you that $370,000. But you're also getting capital gains tax savings. So again, if you're in that rate where you pay that 3.8% surtax on top of the 20% capital gains rate, that could be $190,400 in capital gains tax savings compared with had she sold it. So your real cost of making this gift is not $630,000; it's $440,000, $439,600. So you can see it's better to use the stock for that. If you go to the next slide, we'll look at that in a little bit different way. So this is just comparing what you have before and after. So on the left-hand side, you see you sell the stock, give the cash. In the total assets at the beginning are $2 million. You sell the stock and make the gift to charity. You're holding on to your cash for your checking account or other money market account. But you sell the stock and then make the gift of those proceeds to charity, which is $1 million. But then the next April, or I guess July if you're in a coronavirus world, you've got to pay the IRS $190,400 in capital gains tax. So at the end of the day, you're left with $809,600. Whereas instead, if you'd just given the stock to charity and kept the cash, you start out with that $2 million. You're giving this $1 million of appreciated stock to the charity, which they can then turn around and sell. And because they're a tax exempt organization, don't have to pay that unrealized capital gain. And so you owe nothing in the way of capital gain at the end of the day, and you're still left with $1 million. So that really illustrates the difference. And there's some real world examples of this happening where a donor sold stock to make a gift, and then later had to pay capital gains tax on it when they could have just given the stock directly and been in a better place financially. Next slide, please. With appreciated stock, you can also fund a charitable gift annuity. So here's an example of that. We looked at a charitable gift annuity funded with cash earlier, but now here's one that's funded with appreciated property. So $100,000 of stock with a basis of $50,000. Again, it's just how this illustration might look. The donors, Ole and Lena Olson, are again 75 years old. They get 5% for the rest of their lives. So in this case, $5,000 for the duration of their lives. There's a tax-free amount of $1,893 roughly, and then the rest is broken out between recognition of capital gain over their life expectancy, and then the rest is ordinary income. And at the end of the day, the charity gets a gift of $100,000. So it's even more advantageous because of that capital gains bypass for a donor to establish a charitable gift annuity with appreciated stock as opposed to cash or other assets where they don't get that added benefit. Okay, next slide. We're going to look a little bit at retirement account assets. So we'll advance again. So generally, there's a little bit of a dichotomy here in that from the standpoint of making gifts to charity during lifetime, qualified retirement accounts are usually the worst assets to use for making charitable gift during life. And there are a couple of times when there's an exception. One of those, a clear exception, is qualified charitable distributions from an IRA, which we'll talk about in a moment. Another possible exception is if the donor absolutely has no other assets to use for a charitable gift, and they really want to make a charitable gift. Usually you can get a wash. You know, the donor would have to recognize income when they took the distribution, and then they get an offsetting charitable deduction for the cash that they give to charity. So, you know, they're not in any worse place in some cases. They could actually have an increased adjusted gross income, which if they're subject to phase outs could have some negative effect, but if they don't really care about that, that's not a concern for them. They could go ahead and do that. But if they have any other assets they could give other than their retirement account, it's better to give those other assets because then you get the tax benefit without the recognition of that income. But at death, there's usually no better asset to give to charity than qualified retirement account assets. And again, that's because the recipients or the beneficiaries of that property, when it's distributed, have to pay income tax on that at their highest marginal rate. And so nonprofit organizations, being tax exempt, they can accept those distributions and get the full value of it without having to pay any taxes. And you can leave other assets to your family members rather than the retirement accounts. So we'll advance a little bit, one more, to take a look at one of those exceptions, the qualified charitable distributions or QCDs from IRAs. Sometimes you'll hear these called IRA rollover gifts. It has to be from an IRA, not a qualified plan like a 401k or a 403b. The distribution has to be made directly from the IRA to a qualified public charity. So that's important to note that the donor doesn't take the distribution and then turn around and make the gift. The check should be from the IRA to the charity. The donor has to be at least 70 and a half at the time of distribution. There's some changes to note from the Secure Act that, as I think all of you know, or most of you know, that the Secure Act changed the date of the first required minimum distribution for all people turning 70 and a half in 2020 or later to 72. That said, the age for qualified charitable distributions, the minimum age has not changed, and that's still 70 and a half. So you can let your clients know that they can still make these qualified charitable distributions, even though they don't have to take the required minimum distributions. Okay, next slide. Another thing to note that for qualified charitable distribution, up to $100,000 per year per person can qualify, and if you're a married couple, you can do gift splitting so that up to $200,000 can qualify without having to include those distributions in gross income. There's no quid pro quo allowed, meaning no contributions in exchange for gift annuity or to a charitable remainder trust, and the donor shouldn't get any thank you gifts from the charity for those qualified charitable distributions. A note on the distributions, they can count toward the annual required minimum distributions if they're made before RMDs have already been taken. A change in the CARES Act note is that they eliminated RMDs for 2020, but donors still can and still are making qualified charitable distributions. Okay, next slide. This can help clients avoid taxes whether or not they itemize. It's, for those people more now, since there's an increased standard deduction, or taking the standard deduction, they don't benefit from their charitable giving, and from a tax standpoint. I think they benefit in other ways, but they're not getting tax benefit from the charitable gifts. This is a way for them to make a charitable gift and have some tax benefit, even if they don't itemize deductions. And then also, because it's not included in gross income like a regular IRA distribution would be, and particularly for those people who do have to take RMDs, it can help keep their adjusted gross income lower, meaning that it helps with phase outs and reduction of other tax benefits. One thing to note if you're an advisor, that even though the Secure Act eliminated the cap on contributions to IRAs after age 70 and a half, the age limitation I should say, it used to be that you couldn't contribute to an IRA after 70 and a half. Now you can, which may be something that clients or donors want to do, but really should note that there's an additional provision that prevents double dipping, that says that any qualified charitable distributions are reduced by the cumulative or total amount of IRA contributions made after age 70 and a half. So this means that if a donor turns 70 and a half, makes, let's say, $5,000 a year in additional IRA contributions the next 3 years, and then in that fourth year decides they want to do qualified charitable distribution, they may be unpleasantly surprised to learn, or the charity might find out that the donor doesn't qualify, or that the contribution that the donor made doesn't entirely qualify for qualified charitable distribution treatment, that the first 15,000 of that won't be a qualified charitable distribution. So that's just something to be aware of and wary of. And for charities out there, when you're doing your receipting for these kinds of gifts, something to maybe note that if you've made post 70 and a half contributions to your charity, go talk to your accountant, go talk to your attorney or financial advisor. Next slide. Here's an example to show how a gift of a retirement account at death is really beneficial and compared with other assets that the donor can use. So here Sally wishes to leave $400,000 to children and $400,000 to charity. These are the assets that she has, and can use either qualified retirement account or other assets for these gifts. Which assets should she use for each gift? Well, as you might guess, I think she should use the qualified retirement account assets. And let's see why. So next slide, or next advanced one. If she left her IRA or other qualified retirement accounts to her kids and made charitable gifts, let's say out of her will or through other beneficiary designations, here she's got $800,000 to start. The amount to charity, the charitable gift from her will, say, is $400,000. But then the kids, when they receive this $400,000 from the IRA, have to pay, let's say, in their 35% income tax bracket because of that $400,000 distribution. They've got to pay $140,000 in income taxes. So at the end of the day, the kids are left with $260,000. If she had just flipped that and instead given the $400,000 qualified retirement plan to charity, and given the other assets to the kids, the non-taxable assets to kids, the charity still gets the same amount either way. So it's still in the same position of receiving this wonderful gift. And the kids then don't have to pay income tax like they would if they got the IRA. They're left at the end of the day with $400,000. So which of these plans do you think the kids would prefer? And I think the answer is pretty clear. So with a simple tweak or switch to the plan, you can save your client's beneficiaries a lot of money. Okay, next slide, please. A few changes to note to qualified plan distribution rules from the Secure Act. I think many of you probably already have been in multiple webinars or gotten pieces on these changes, but just to review for those who aren't following it closely, that as a result of the Secure Act, stretch IRA planning and beneficiary rules for qualified retirement accounts have been largely eliminated. Whereas it used to be you could use life expectancy to stretch out the payments. Now there's a 10-year rule. There's a 10-year limitation that the distributions have to be made within 10 years. That can be a problem if there have been trusts that are set up to say pay out the required minimum distribution every year, like accept these payments and pay out the required minimum distribution as a conduit or pass-through trust. If there are no required minimum distributions, then there are no payouts until the very end, that 10-year window when the trust has to pay out all the income. So that can be problematic for donors. There are some exceptions to this. Surviving spouse is the most notable one, but also if they're minor children, until they reach the age of majority, they don't have to follow that 10-year rule. But then once they do hit majority, they do have to follow the 10-year window. Disabled or chronically ill, or someone who's less than 10 years younger than the account owner, they're not subject to that 10-year distribution window. But most of the time, your kids are going to be more than 10 years younger than you. So, that's a pretty significant change. If we go to the next slide. Next slide, please. Are we stuck here? Hey, Christine, are you able to? Oh, there we go. Thank you. So the Secure Act changes, there are a couple of different takeaways from this. And one is that designation of retirement account proceeds to charity are even more attractive because it's less attractive to give them to children when they can't stretch them out over a longer period of time. It's going to mean more income taxes paid by the kids generally, unless the change like this is made. And then there are some other options to address it. You can make a discretionary trust or trustee that the beneficiary of those retirement account assets that would dole it out as the trustee deems advisable over time. Or what many people are doing are charitable remainder trusts that would, again, even out the income to say pay 5% or 6% per year to the designated beneficiary, and then at the end of the term, the remainder goes to charity. So those are a couple of possible solutions for that change. Okay, next slide, please. You can make gifts using life insurance, and again, this could be a lifetime gift of policy with cash value, and then the donor paying the ongoing premiums of that as additional gifts. And you can also make charity the beneficiary of the policies for the death benefit as a testamentary gift. Next slide. Real estate, we've talked quite a bit about that, so I won't go over it again. We've talked about the transfer on death deed. If you want to take a look at the Minnesota transfer on death deed statute, that's available at Minnesota statute section 507.071. It was enacted in 2008. Okay, next. We talked a little bit about, again, a gift of real estate to a flip crud. And just to review that real quickly, that's where the donor places real estate into this charitable remainder trust that would pay out just the net income of the property until the property is sold. And that's the flip triggering event that once the donor is able to get the proceeds from the sale and reinvest it into liquid assets, then it starts paying out that 5%, 6% interest, whatever the donor chooses as the payout percentage for the rest of their life or a term of years. And I put in another plug again for community giving and the affiliated community foundations because they have great experience in handling these kinds of gifts. If you're looking for someone to serve as trustee or you're looking for more advice or information about those. Next slide. The gift with the retained life estate. Now, this is the last thing that we're going to talk about in any depth. And this is a situation where the donor makes a gift of real estate to a nonprofit, but retains the right to live in and use the property for the rest of their life. The donor would get a current income tax deduction for that present value of that life interest, which is calculated again using that section 7520 rate, which is very low right now. And then the donor also agrees to pay ongoing maintenance, insurance, and taxes for the upkeep of the property while they're living. That would be a side agreement with the charitable organization because it's to their benefit. And then when the donor passes away, the charity is the owner of the property. So let's advance one more. Let's take a look and see what this would look like in an illustration. So here we've got property. Let's say is worth $400,000. The donor makes a gift in May of 2020. Of this property to charity, but retains the right to live in and use that property for their life. Now, there is a charitable income tax deduction here of $313,938, which, if the donor is in the 24% federal tax bracket, would save them $75,000 in real money this year, more if they live in a state with income tax like Minnesota. And then the donor gets to keep living in the home or use the property throughout their life. And when the donor passes away, then the charity is left with the property which it owns in full. And here we assume a modest growth rate, a 3% annual appreciation, a 1% sales cost, and then the charity would end up with over $650,000 from this gift. It can be really nice if the donor knows that they want to leave this property to charity eventually anyway, and they could benefit from a current charitable deduction, which is really high right now with the current AFR. So if you go to the next slide. Just to show the difference in that AFR can make, just a few months ago on December 28, you see the rate was 3.6%, 0.8% now. If you just look at the difference in those charitable deductions, $627,853 in December versus about $820,000 now. And the tax savings, almost $50,000 more tax savings now just because the rate's lower a few months later. Next slide. Taking a little bit more extreme, looking at the comparison between now and 8.2% AFR in March of 2020, it's even more profound. You see the tax savings at the 37% bracket, $232,000 in, $163,000 in March of 2020, $303,000 right now. So that's a pretty substantial savings. Next slide. There are other assets that people can use. Tangible personal property, as we mentioned earlier, can include artwork, musical instruments, cars, planes, boats, jewelry, and anything else that's tangible, as you know, as advisors. Next page. Closely held business interests, don't forget about those. Many donors don't realize that they can use closely held stock to make charitable gifts, or they assume that they can't, but in many cases they can if the circumstances are right. Oil, gas, and mineral interests can be really valuable. I mean, right now, with oil prices where they are, they aren't as valuable, but in other times it can be very valuable. Intellectual property rights, and then crops, livestock, and farm machinery also can be used to make charitable gifts. There's a summary page here. I won't read through because I want to leave a little bit of time for questions, but we'll just make a couple of points. Just remember that you can help your clients in this time of stress and anxiety and uncertainty. I encourage you to think a little bit more about those values-based planning principles that we talked a little bit earlier. There's some recent tax law changes and legal changes that are reasons to communicate with your donors that have some potential benefits and potential challenges, and they're charitable tools that can help solve those problems. The historically low AFR and low asset values provide some opportunities for planning that we've talked about today. Charitable gift annuities might be attractive to donors where they're concerned about levels of income or low savings yields, and then don't forget about other assets that your clients may have to make charitable gifts. So thank you so much for spending this time today listening to this. I hope you found something of value in it and there's something you can use. With the few minutes we've got left, I'd be happy to answer any questions if there are some.
Hi, Joe. This is Sarah from the Wilmer Area Community Foundation, and we do have a submitted question for you. And that is from Greg. And Greg is asking, could you explain the difference between a corporation making a charitable gift versus just treating it as a business expense?
Sure. So that's a great question. And when we see that come up in the context of underwriting or marketing, and you can think about public media as an example. Well, sometimes a corporation will make a contribution to a nonprofit organization in exchange for, let's say, media or that they're getting some sort of publicity or benefit. And in that case, it would be a business expense. And there are sometimes some benefits to organizations doing that, and maybe they can deduct more of the contribution for that, as opposed to a purely charitable philanthropic gift where they expect to get nothing in return. So I think the defining difference is, do they expect to receive something in exchange for that contribution? Is it really intended as marketing, or is it purely philanthropic? I think there's a real gray area, and it can be sometimes a fine line as to how do we characterize this? What is this? I think, you know, part of the difference is what they expect to get back in return. Would they have made this gift absent this contribution absent the publicity for it? But we do know that recognition is one of the reasons why donors make charitable gifts. Very often, it's simply, where in the company is this coming from? Is it coming from the marketing department, or the sales arm, in which case it's probably you know, a business expense, a marketing expense? Is it coming from the company's foundation or the pool of funds from which they typically make charitable gifts? Then it's probably considered a charitable contribution. But it's a great question, and there is a gray area there.
Great, thank you, Joe. At the end of this session, everyone will be receiving the slide deck. And I want to point out that there have been a couple of important threads inside the chat feature. So if you haven't accessed that yet, just go ahead and click that chat. One of which is to remind you that Community Giving and all of our partner foundations operate a planned giving calculator that is accessible to all of you. And if that would be of help, you can go to plannedgiving.cg.org. and you should be able to see that, or please give one of our staff a call. We are happy to assist you. Steve, I'll turn it back over to you.
Great, thank you, Sarah. And I just want to say thank you to everybody for coming, and we appreciate the support we get from all of our professional advisors, and we want to really stay in touch with you. And if you do have very specific questions that you have either for Joe or for any of our team members, please reach out, let us know, and we'd be happy to get back to you with the answer. And we do have the calculator, and we're happy to discuss and talk about potential gifts with any of you. Thank you so much, Joe, for sharing your information. Remember, continuing ed credits are available. If anybody has questions on that, let us know. All of the resources for community giving are on the web at communitygiving.org. And as always, we invite your feedback and comments and ideas. If you want to email us at info@communitygiving.org, that would be the way to reach us, and we can make sure the right staff person gets the question or information. Finally, next week, we're going to be back at 2 o'clock in the afternoon with our community connections, and we're going to be featuring Kate Barr from Propel Nonprofits, talking about forecasting and budgeting, which we all know for all nonprofits has changed probably substantially given what's going on in the current environment. We wish you all well, and again, thank you for all the great work that you do on the front lines in our communities, and we appreciate all that you do. And stay safe, stay well, and tune in next week, and we look forward to visiting with you then. Thank you.